while being slightly fast-paced. The U.S. market is currently closed, but the last reported price for SOFI Technologies Inc., SOFI, at the close of trading on October 10, 2025, was $26.19, representing a significant single-day drop of 7.94% from its prior close. This sharp daily movement is not merely a technical pullback. It's a critical reaction to a high-stakes political whisper, the potential examination by the Trump administration of selling a massive $1.6 trillion portfolio of federal student loans to private entities. This is the unexpected angle you need to understand. The narrative around SOFI is not just about its impressive member growth or its cross-selling success. It is now fundamentally tied to a massive, politically charged external catalyst that could either become a generational windfall for their core refinancing business or an unpredictable regulatory nightmare. The market's expectation following months of soaring returns was for continued linear growth fueled by its online investing expansion and core lending performance. But the reality is that a single high-magnitude governmental decision has the power to dwarf all organic growth metrics in the short to medium term. The massive volatility, underscored by trading volumes surging 61% above average, confirms that investors are grappling with a dichotomous outcome: a huge opportunity for its student loan refinancing or a major disruptive force that could change the competitive landscape entirely, pushing some to consider more traditional, stable alternatives like Fidelity or Interactive Brokers. The common ground for investors is the belief that SOFI is a quintessential fintech disruptor, challenging old-school banks with its Financial Services Productivity Loop, or FSPL. They see a company executing flawlessly, consistently delivering record member and product growth, 11.7 million members and 17.1 million products as of Q2 2025, and finally achieving GAAP profitability for its 7th consecutive quarter. This is the expectation: a rocket ship transforming into a stable, profitable financial institution. But here is the challenge to that narrative. The company's valuation, with a price-to-earnings ratio north of 100 on one measurement, prices in not just flawless execution, but accelerating near-perfect growth. The reality is that the core lending business, particularly student loan refinancing, remains highly sensitive to macro factors and political whims. And the recent sell-off suggests that the market's patience for that perfect execution is brittle. A substantial portion of the company's bullish thesis relies on the uninterrupted success of the lending segment, which has historically been its bread and butter, even as they push aggressively into SOFI Invest, banking, and the 𝐃𝐈𝐒𝐂𝐋 technology platform. This dependence creates a tension, where the good news from their diversification efforts, such as the launch of Options Level 1 for beginners on SOFI Invest or the introduction of the Agentic AI ETF, can be instantly overshadowed by a single headline related to student loan policy. The dramatic intraday movement to $26.19 demonstrates that capital is flowing out first and asking questions later when faced with high-level, unpredictable regulatory risk. Let's dissect the recent stock movement and the forces behind it. The drop on October 10th was a direct result of that governmental proposal news. For a company that began its life focused on student loan refinancing for high-earning, responsible borrowers, the prospect of a multi-trillion-dollar pool of assets suddenly being made available is transformative. It would fundamentally change their addressable market, allowing them to scale their core offering in ways that organic growth simply cannot match. However, the sell-off indicates deep investor concern about the terms of such a sale, the regulatory hurdles, and the risk that a prolonged political battle could create instability and dampen demand for student loan refinancing in the near term. Furthermore, this move highlights the company's continuous need to balance the high-growth, high-risk lending segments with the lower-margin but stickier financial services segments. While SOFI Invest and their core banking products are seeing massive adoption, financial services products grew by 35% year-over-year. The lending segment, with its direct tie to interest rate and government policy, remains the most powerful short-term lever on the SOFI stock price. Institutional activity leading into this drop had already shown signs of discord, with the last quarter seeing a significant number of institutional investors both adding and removing large positions. This lack of clear institutional consensus signals a deep-seated philosophical debate on the stock's future. Is it a high-growth tech stock deserving of a Tesla stock-like multiple? Or is it a bank which should trade closer to traditional financial multiples, closer to a value proposition you might find on Fidelity's platform? The competitive landscape only amplifies this tension. SOFI is not just competing with other fintech unicorns like Robinhood, which focuses primarily on commission-free trading, Robinhood stock trading, and crypto, but also with giants like Fidelity Investments and Charles Schwab. In the investment space, SOFI Invest offers an intuitive interface, commission-free trading, fractional shares, and the increasingly popular options trading capability, including the newer Level 1 strategies for beginners. However, it still lacks the breadth of products like extensive mutual funds and fixed income products offered by the venerable established firms. The true differentiator for SOFI is its full-stack offering, lending, banking, and online investing, all under one roof, tied together by the lure of the SOFI Plus membership, which grants higher savings APY and unlimited access to financial planners, a perk few competitors match without a significant wealth management fee. This unique strategy is what the bulls point to when they justify the high valuation, arguing that the lifetime value (LTV) of a cross-sold member drastically lowers customer acquisition costs. To fully appreciate the company's trajectory, we must understand its core business model. SOFI Technologies, Inc. operates a digital-first financial services company built around a one-stop shop concept, catering primarily to the Henry demographic, high earners not rich yet. The model has three core segments: lending, personal loans, student loans, and mortgages; technology platform, Galileo, which powers over 160 million accounts globally for other fintechs and institutions; and financial services, SOFI Invest, SOFI Money, and credit card. The goal is to onboard a member with one product, often a loan, and then cross-sell them into the entire suite of services, from self-investing to a high-yield savings account. The bank charter, secured in 2022, was a game-changer, dramatically lowering the company's cost of funds, which in Q 2025 resulted in approximately $551.9 million of annualized interest expense savings compared to previous warehouse facilities. This strategic move directly impacts the profitability of the lending segment, which is its largest revenue driver. Past performance has shown remarkable growth. Q 2025 saw record net revenue of $855 million, up 43% year-over-year, and GAAP net income of $97 million. These results exceeded management's own expectations, leading them to raise 2025 guidance. The reality is that the financial machine is humming, but the market is fixated on the engine's fuel source, lending, and the external factors that can interrupt its supply. Looking ahead, the future outlook for SOFI is a kaleidoscope of high-potential catalysts and significant macro risks. The most immediate catalyst is the upcoming Q3 2025 earnings release scheduled for October 28th. Analysts are expecting continued strong growth in both member count and revenue, but the focus will be intensely placed on net interest margin in the face of a high interest rate environment and, crucially, any updated commentary on credit quality and loan loss provisioning. The analyst sentiment is currently fragmented. A consensus hold rating with a median price target significantly lower than the recent high suggests that Wall Street has a more conservative, reality-based view than the retail excitement often seen on platforms like Robinhood. Price targets range wildly, from a highly bearish $14 to a highly bullish $31, underscoring the deep uncertainty surrounding the valuation. This is the ultimate test of the expectation versus reality principle for SOFI stock. The expectation is that the FSPL model is so robust it can withstand any macro headwinds. The reality is that the cost of capital, the pace of the Fed's rate decisions, and a potential slowdown in consumer spending could significantly pressure the highest margin segment, leading to profit margin compression and elevated customer acquisition costs, as some bearish analysts fear. Furthermore, the company is not standing still. Traditional brokerages like Fidelity are refining their mobile apps and lowering fees, while tech-focused platforms like Interactive Brokers are continuing to lure sophisticated traders with advanced tools and lower margin rates, which is pressure that SOFI must constantly fight. The company must also execute on the cross-border and crypto initiatives that social media is buzzing about to maintain the growth narrative and not become just a bank. In summary, the narrative surrounding SOFI Technologies Inc. is a high wire act between the immense expectations